As you may have noticed, the global markets are in a lull. Although assets are showing some movement, investors are mostly waiting for new data on inflation in major economies. Against this backdrop, the US dollar index reached the mid-week equilibrium level of 104 points, strengthening significantly against the Australian and the New Zealand dollars. If you follow our video reviews, you may have prepared for a spike in volatility in the Aussie and Kiwi pairs following the release of Australian inflation data and the Reserve Bank of New Zealand's interest rate decision. The Reserve Bank of New Zealand kept interest rates unchanged, but offered a less hawkish view on the monetary policy, which stunned the market. Policymakers said that the risks to the inflation outlook had become more balanced and lowered the forecast peak in the cash rate to 5.6% from the previous forecast of 5.7%. Against this news, the Kiwi lost more than 1%. The Australian dollar also depreciated after data showed that annual inflation was at 3.4% in January, unchanged from December and below market forecast of 3.6%. The weaker inflation data from Australia has taken traders' focus away from the possibility of another Reserve Bank of Australia rate hike. We suggest investors may shift their attention to releases from the United States, Germany, France, and the Eurozone. Inflation or deflation? This is the main question for the end of the trading week, for the winter and the future market sentiment at all. The answer is in our video review. You are watching the Traders Calendar. The Eurozone may see continued deflation, which could open the door for an earlier interest rate cut by the European Central Bank. The overall picture for the Eurozone will be clear on a Friday. However, the market will get a glimpse of the inflation levels in individual economies across Europe on Thursday. On this day, the market will digest inflation data from France. In January, France's annual inflation rate slowed to 3.1% from 3.7%, in line with the forecast, and this was the lowest rate since January 2022, as the overall food inflation slowed to more than a 1.5-year low of 5.7% from 7.2% in December. Looking ahead, the market is expecting the CPI to drop further to 2.7%. A higher than expected reading could provide a short-term boost to the European currency. If the index is in line with the expectations or comes in lower, the euro may lose somewhat. At the same time, the market's reaction to the French data may be short-lived, as it will add a little to the overall picture. Meanwhile, the German CPI data could be the basis for intraday sentiment on the euro. The country is going through a rough patch. Europe's largest economy contracted by 0.3% in 2023, making Germany the worst performing economy in the world. It's expected to slide into another technical recession in the first quarter of this year. The German government has revised its economic growth forecast and now expects the economy to grow by 0.2% this year. The government highlighted inflation separately in its report, as its high levels are eroding purchasing power. January's data showed that Germany's consumer price index declined to 2.9% due to a sharp slowdown in commodity price growth, lower energy costs, and cooling food inflation. Based on Thursday's data, the market is expected to further slow down in price pressures to 2.6%. If the data comes in above market forecast, intraday trading will be on the side of the euro bulls, while weaker inflationary pressures may force investors to sell the euro and increase expectations of the ECB rate easing ahead of the Fed. Later on Thursday, the most important data will be the Personal Consumption Expenditure Index and the Fed's main gauge of inflation. Last week's reports underscored the challenge facing the regulator as the slowing inflation hinders on falling commodity prices. The rate of overall consumer price inflation slowed to an annualized rate of 3.1% in January, down from 3.4% in December, but the core index, which excludes volatile food and energy components, was unchanged at 3.9%. The Personal Consumption Expenditures Index increased by 0.2% in December on a monthly basis, in line with the market expectations. On a yearly basis, core PCE prices surged by 2.9%, below market estimates of 3%, and the lowest reading since February 2021. Consumer inflation is expected to accelerate to 0.4% in January, but the year-over-year rate is expected to fall to 2.8%. If the deflationary trend proves to be sustainable, it will weaken the US dollar. On the other hand, if the data beats market expectations and inflation proves to be persistent and strong, the US dollar will get a strong boost and could quickly hit its 2024 highs. Today, higher than forecast US inflation has prompted markets to reduce bets on the number of interest rate cuts expected by the Fed this year, with a probability of a June rate cut at around 60%. At the beginning of the year, markets were almost entirely pricing in a March rate cut. Ahead of the US trading session, the loonie, which continues to lose ground against the US dollar amid the growing likelihood of a rate cut by the Bank of Canada, may also gain momentum. Notably, Canada's headline inflation rate decreased to 2.9% in January, down sharply from 3.4% in the previous months, supporting the dovish stance of Canada's financial regulator. Canada's GDP shrank at an annualized rate of 1.1% in the third quarter of 2023, the first contraction since the second quarter of 2021, and a sharp contrast to market expectations of a modest growth. Preliminary data indicated that the Canadian economy likely rebounded in the fourth quarter, with a growth of 0.8%. If the data are in line with the market expectations, it would mean that Canada has avoided a technical recession. If the December estimate is confirmed, it will also signal that the Bank of Canada was wrong in its forecast of zero growth. If the data matches the estimate, we do not expect strong moves. However, if market expectations are not met and the economy doesn't recover, the loonie may strengthen on lower expectations of a dovish reversal. On a Friday, Eurozone inflation data will be released. Notably, EU inflation fell rapidly last year and is now just below 3%. However, the ECB said it may take more than a year to bring it down to the 2% target, despite a record string of rate hikes. Eurozone inflation was confirmed at 2.8% in January, little changed from December's 2.9%. Analysts expect the fresh data to show a slowdown in the pace of price pressures. Market estimates point to a sharper drop in the CPI to 2.5% from 2.8%. However, while energy prices are well below expectations and economic growth is weak, wage growth remains brisk, and this puts additional pressure on the ECB. If the market's assessment is in line with the forecast, the euro could retreat across the board. If the data comes in higher than expected, the single European currency could get a boost. In any case, investors will be able to assess inflation in the major economies of the Eurozone and the US before the data is released, which will make it easier to evaluate the euro and to build forecasts. This was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades. See you online soon!